Mine still shows I'm in a practice session.
We are live.
Huh. Maybe I need to, okay, great. Well, I wish I could be there in person. I love Atlanta, especially as it gets colder elsewhere. I love Atlanta.
Maybe next time. We'd love to have you.
I was there quite often when I worked for Credit Suisse, because Credit Suisse had a big Atlanta office. I know today Credit Suisse is a bad word, but I had a very great experience there. It was a great firm. It was back in the 2000s. Maybe they'll get out of this mess and recover. I hope. We'll see. But I haven't been at Credit Suisse for a long time.
So Professor Litman, I'm gonna go ahead and get started.
Great.
Good afternoon, everyone. Welcome to our online series, Stock Markets and Crisis, for the remainder of 2022, Insights from Inside the Pentagon. Before we start with the presentation, I just wanted to talk about some upcoming events, including there's an online series on October 21st from 12 to 1 p.m. It's called the Executive Job Search, Planning and Organizing Your Campaign. Also, there's another online series called the Introduction to DeFi on October 26th from 12 to 1 p.m. We also have our annual conferment dinner, which is on November 9th from 5:30 to 8 p.m. So please check our website for more details on these events and other programs, and please register today. I'm really excited to be joined today by Professor Joel Litman. Professor Litman is the chairman and CEO of Valens Research and the founder and chief investment strategist of Altimetry Financial. Just a quick housekeeping note before Professor Litman gets started. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, Professor Litman, I'll go ahead and turn it over to you. Thanks so much.
Thank you, Charlie. And thanks to Kathy for getting this set up. FA is actually with Valens. You see his video there at the bottom helping. Look, there's a lot of these. I like the charts. I love charts. I do. And the pictures can tell 1,000 words if the charts have good data. But in this, it's showing the U.S. share of the world economy. And post-World War II, everyone had to buy U.S. products because the manufacturing of Asia and Europe had been destroyed because of World War II. And so given from 1945 to 1960, the U.S. really had a heyday of pretty much whatever the U.S. made, people had to buy. So that continued until around the 70s, where unbelievably high tax rates and high inflation caught up with the U.S. In a bad way, leading to stagflation. Notice, I didn't just say inflation, high inflation and unbelievably high tax rates. Marginal tax rates that hit at one point in this period of time as high as like 90%, but easily 75 plus, effectively close to 100%, meaning you were getting taxed almost all the money you'd make. Anyway, the US's share of GDP has been declining ever since as the US, as the rest of the world grows. And of course, in the rest of the world is China. And they make a point in visual capitalist. I like visual capitalist stuff. It's just that there's no one there really auditing. It's not that the data is wrong. Is it the right data? I'm not arguing that the GDP data is wrong. I'm just saying, should we be using GDP at all? Right? I'm serious about that. Should we be? So anyway, here's China growing 4 to 16, and no matter who, where you look, people are saying, and soon China's going to take over the world, and you get these pictures that make it look like it's a bipolar world, and countries are going to have to choose between one or the other at some point, to include people teaching their children Chinese, Mandarin, right, around the world, because they believe that China's going to take over, which, anyway. And this partnership with Russia is going to be a problem for the United States. And there's, even Americans by the Pew Research Center believe that China will be the world's leading economy, and that there's this new Cold War potentially forming. Right? This is all in the last 6 months. And that China's revenue, corporate China's revenue, is catching up. It's almost there where the United States is. Now, I've been inside and out of the Pentagon, and people are showing this data, right? An advisor inside the Pentagon. And people often show me data. They say, well, what about this? What about this? And CSIS and these China Power pages is one of them. Well, first I said, where's CSIS getting their data? Do they have financial analysts internally? They have like 50 CPAs sitting there doing this work. And if you look at the bottom, oh no, they're getting their information from the Fortune 500. Interesting. From the Fortune 500, which, by the way, the Fortune 500 also says, right? Look at this. It's surprising that little coverage was given. So it could be seen as a major development in superpower competition, meaning, look at, there's more Chinese companies in the Fortune 500 than US. Based on what metric is Fortune deciding this? I'm asking. Anybody know who owns Fortune magazine? Anybody know who owns Fortune magazine? The richest Thai family in Thailand owns Fortune magazine. They bought it about 4 or 5 years ago. I don't know if anyone knows this. And since then, you start seeing this very pro-China discussions and data that you just say, based on what data are the biggest companies in the world now Chinese? Well, let's see. That richest family in Thailand owns 200 mainland companies in China. 200. And lo and behold, we get this Fortune Global 500 that seems awfully favorable to China, despite what the data says. But, you know, Americans read this, they assume Fortune magazine does their work, does their research properly. I don't agree, but anyway. And then all this news, war has brought the world to food crisis and looming oil crisis, right? Drill, baby, drill is gone forever, said a Saudi prince, Abdulaziz bin Salman, right? ABS said, drill, baby, drill. Oils, you know, the shale revolution is dead. It's gone forever. Gone forever. Well, if we believe this, we start to believe that, you know, things are bad. And by the way, interest rates have been rising faster than any time in recent history. That should scare everybody, along with inflation and what have you. So anyway, we get these pictures supporting that China is going to be the bigger one and U.S. is declining until we look at the right data. Now, how should we look for the most accurate economic metrics, right? I mean, how should we look about it? I'm not just saying, what are they? I'm saying, from what basis do we look at? What philosophically? And I'll tell you, in my response, I would ask these people. Now, those of you who are CFAs, as this is CFA, right? Those of you who are CFAs should recognize this picture. I hope you do. And if you don't, well, then this should be part of the CFA exam, in my humble opinion. Because it's the greatest picture in the history of value investing ever, right? Who created the CFA? Of course, right? It was created by a guy and several others named Ben Graham, Professor Ben Graham, who wrote a couple of books, The Intelligent Investor, probably the best book on investing ever written. Who said that? Warren Buffett said that, right? And Security Analysis, maybe the second best book ever written, with Seth Klarman and Bruce Greenwald and others doing commentary on that one. So why do I bring this up? Look at the students in this picture. Who's this student? Oh, that's Warren Buffett. Who's this student? Look at the smile. That's Charlie Munger. People don't know that Charlie Munger's performance was better than Buffett's before he joined Berkshire Hathaway. Charlie did 15 years where he did something like 15% alpha per annum for 15 years straight. 15%. If you look at your numbers, it's actually better than what Buffett was doing. So anyway, Charlie joined Buffett, and now they're Berkshire Hathaway. Tom Nepp and Ann Anderson started Tweety Brown. I don't know if you know Tweety Brown, but that's a $10 billion company. They beat the market for 20-something years right out of the box. Right out of the box to beat the market. Isn't it amazing all these people had the same teacher? This is my goal as a professor, is to teach a class where I get a bunch of alumni together and, you know, half of them become billionaires like Walter Schloss, who did this 700% of what the market did over the course of 45 years. Phenomenal, became a billionaire, right? All following the great Ben Graham. Bill Ruane, right? The Sequoia Fund crushed it. Bill died around 2005, but Sequoia's done a good job of getting back after a little blip of loss from when Bill left. But the point is, the greatest investors in history, these guys, and let me throw in another bunch. These guys, right? Shelby Davis, Seth Klarman, they didn't make the picture. They're either too young or they weren't in the actual class. Shelby Davis, obviously a follower of Ben Graham. I don't know Shelby Davis. Shelby Davis, who's Shelby Davis? Second president of the CFA Society of New York, or I guess was called at the time the NYSA NYSSA. Second president of the CFAs, definitely a follower of Ben Graham's. Took 50 grand, turned it to 850 million as an investor. Anyway, These are the greats of investing. And guess what? You can see an homage of all of them to Ben Graham and Ben Graham's work. So we want to pay attention to these people because the greatest investors in history by default are the greatest business analyzers in history. And I'm going to suggest to you that if you're a great business analyzer for a single company, that is the same discipline you should apply when looking at an economy, right? We can't just say, oh, I've got, 30,000 companies to look at. But when I do my aggregate country by country analysis, I'm going to forget all that. I'm just going to look at GDP as if GDP represents a country's power. It does not. It does not. I'll show you the metrics that matter. Of course, it's cash flow. But what is cash flow for a country? We can see that. So anyway, I'm teasing you for what I'm going to say before I finish in the next 35 minutes. So the great Ben Graham, in his words, he wrote a book that a lot of people don't read, but geeky people like I do, The Interpretation of Financial Statements. A lot of people look this up and they're looking at a Buffett version of the interpretation of financial statements, but the original one was written by Ben Graham. And in it, he says, hey, by the way, earnings is wrong. He didn't say wrong. He said readily above or below what it should be. He didn't say always below or above. He said it's readily either one, and you better be prepared to adjust it. And yet, how many times does CNBC or the Wall Street Journal adjust that number? And don't tell me adjusted EBITDA from the company counts. You can't rely on the number from the company. Of course, the company's going to adjust it however they want to make it look as good as they want. You need an outside body like FASB to say, here's what we're doing, but FASB doesn't do it. Why? I don't know, because they don't want to pay attention to CFAs, right? The accountants don't anyway. I'm a CPA also, right? I'm a CPA, but anyway, they don't listen to me anymore. Charlie Munger, what did he say? Accounting is a crude approximation. If it's crude when looking at a company, it's crude when looking at 10,000 companies and judging the economic power of a nation. Of course it is. It's really, really bad. Let's see. Let's keep going. Seth Klarman. Who's Seth Klarman? You know Seth Klarman, right? Here's Baupost. That's his performance since he wrote the book, Margin of Safety, right? Margin of Safety, an homage to a chapter in Ben Graham's book, Margin of Safety, right? The chapter is called. So anyway, that's his performance for the S&P, right? And he sticks through 07 to 08. He does have a beta against the market, but man, does he come out of these recessions killing it. And here's Klarman, and he says in his book, analysis of reported earnings can mislead investors as to what's really going on. If it'll mislead you in a single company, it'll mislead you on the aggregate looking at an entire country, which is Fortune magazine's problem. Fortune keeps looking at, as reported in the financial numbers, and just slapping them all together and going, see, look who the great companies are. And you go, yeah, but if it doesn't work on an individual basis, why would doing a gigantic average of all the companies make it, does that somehow clean up the errors? Averaging a bunch of bad data, does that make it good data? Just by aggregating or averaging bad data? Of course it doesn't. Of course it doesn't. But, we just want to get press and scare people and force people to click on our websites. The newspapers say, and the popular financial media. So anyway, Marty Whitman, there's Marty, one of the great credit analysts and credit investors of history, right? Marty Whitman. And what does he say, right? Third Avenue Value Fund. Generally accepted accounting principles are not truth or reality. And yet, I know people are going to finish this call today and go, yeah, but I still like this company because the PE is 10. Well, is it? Is it 10 or is it 50? Because if it's 50, you probably have a different understanding, right? If under uniform accounting, that is the replacement for GAAP accounting, right? If under, it's not a replacement that FASB wants to hear about or that you're going to see anytime soon from the SEC, but it is what investors look at, some version of uniform accounting. Everyone is, BlackRock has its own version of uniform accounting. They don't call it uniform accounting, but it's uniform accounting, meaning they're adjusting companies to get to one solid response. Buffett and Munger, this is 2018. In the first 10 minutes, if you don't trust me, go look at the video. That 4-hour program with the Q&A and everything else, they said in the first 10 minutes, hey, by the way, don't bug me about Berkshire's net earnings figure because it doesn't represent what we're doing. And then look at, don't blink. Don't blink. Next year, here's 2019. It's like they never left the table, except look at the ties are a different color. They still got their, Coca-Cola sponsorship up there. But anyway, and their peanut brittle. They always have their peanut brittle. But here they are in 2019. Again, in the opening remarks, Buffett attacks GAAP. He said it's distorted. He said the bottom line is capricious. What does capricious mean? It's moody. Well, if it's wrong for a company, it's wrong in aggregate. So we can't do macro analysis unless you can first do uniform accounting analysis, company by company, and then aggregate, and then average, and then say, where is a company in its life cycle and where is a country in its economic life cycle based on the businesses inside it, right? It's really a shame, Buffett said. And then he added, I guess not everybody studied accounting. You're absolutely right, because if you do study accounting, you walk away going, GAAP accounting is awful. And by the way, the non-GAAP numbers that the companies produce, also awful. I'm not saying you should follow the companies who are saying, oh, we're going to do our own adjustments, just trust us. Of course not. Of course you don't trust the IR number, adjusted EBITDA or whatever kooky number they've come up with. Of course not, right? We have to have one solid uniform accounting calculation. So anyway, I've made a career out of, look, while I was working on Wall Street, I have to laugh. While I was working on Wall Street, I published an article called Give My Regrets to Wall Street. Do you know what that's called? That's called career-ending decision. If you work in an investment bank, publishing an article saying, by the way, investment banking seems to have a lot of issues, probably is not good for your career. Anyway, I thought people would understand the academic view I was taking. And anyway, I had to leave Credit Suisse eventually for all kinds of reasons. One of which was they never wanted to do anything that I wanted to do from a research standpoint, right? Of course not. The client is the corporation when you work for Wall Street. It wasn't Credit Suisse. They're all the same. It's not like Goldman would have allowed me to run around doing forensic accounting analysis of companies and saying which of the Goldman's clients were probably playing games in their financial statements. It's not like they're going to allow me to do that. But anyway, so I made this case. Wall Street are going to hear me picking on Goldman, but I could pick on all of them. All of Wall Street research follows GAAP accounting or the adjusted numbers, the non-GAAP the company is providing, and they opine on it. And they're both wrong, right? They're both wrong. So this is from P.J. O'Rourke. I don't even know P.J. O'Rourke he has his own magazine, American Consequences. What Wall Street won't tell you. This was like 3 years ago. Anyway, you can't trust the numbers you did on Wall Street. I made a career out of this. So, right, the financial media is always talking about this stuff. It's terrible. The greatest investors in history and the smartest business analysts in history do not rely on as-reported Wall Street numbers or media or the corporation's performance calculations either, because every corporation does their own version and they change their calculation from year to year sometimes. At which point you're like, if you're going to change your adjusted EBITDA calculation every year, how do I possibly use it? And by the way, you telecom company are doing a different adjusted EBITDA than the other 10 telecom companies or pharmaceutical companies, right? Or biotech companies, you name it, right? You name it, or consumer staples companies. So Buffett has been buying Amazon. Oh no. Traditional value investing is dead. Buffett's crazy. He's lost his mind. He's too old, they say. Investopedia, be careful. Be careful, Investopedia. You sound like your name is encyclopedia, but you've got a lot of opinion. Investopedia has a lot of articles that are opinion masquerading as news. Amazon never makes money, but no one cares. That's an opinion. That is not news. Do you really think Amazon never makes money? And that's why it's one of the biggest market caps on the planet? IBT, they all get it wrong, right? Why? Because they're using GAAP accounting. Using GAAP, well, the SEC says use GAAP accounting. Really? Because the SEC says you do it, that means it's right? I'm just asking. The SEC doesn't have time to rebuild the accounting. They just say, well, we need something, we need standards. GAAP is a good starting place. At least we get that done, right? And Amazon here, no profits, no problem. Is this true? Of course it's not true. Even TechCrunch gets it wrong. You'd think the tech experts at TechCrunch would realize that innovation is punished because R&D is expensed in the United States when it's capitalized in other countries. How do you compare Amazon to other countries? How do you do aggregate country analysis when the US forces companies to 100% expense R&D and pretty much every other country in the world allows you to capitalize? How can I compare the two? How can you compare earnings when one's capitalizing R&D and one isn't? You think it just washes out magically? Of course not. These are gigantic numbers. So anyway, here's Amazon. Here's a stock going up 3 times the market. You can't tell because it's gone up so much, but that blue line is 3 times the S&P in the early 2000s. And this is when I was working on Wall Street, by the way. This is during my career on Wall Street. And here's their GAAP number, right? Befuddling people. The GAAP return on assets, that's GAAP earnings over GAAP assets, looks like the return on assets is falling. Their earning power is falling. Here's economic reality. As we were publishing back then, literally off the charts, because my chart caps at 40%. It's literally off the charts. And if I were to show you just when Buffett started buying, and I'm just using straight up EPS now. But like, oh, return on assets, there's so many calculations for ROA and ROIC. No, there really shouldn't be. If you calculate earnings correctly, and if you calculate assets correctly on a uniform basis, you don't need a bunch of adjustments because you already made the adjustments to get the correct numbers. Anyway, here's just plain old earnings per share. Plain old earnings per share, as reported, EPS. This is before their stock split. This is before the stock split. So this is what Buffett's team was looking at. And I know it wasn't Buffett personally buying Amazon, it's Buffett's team, but right, I mean, forgive me, Berkshire Hathaway. So anyway, it says earnings was only $20 a share, ramping up to $23 a share, right? What was reality? Not only was it higher, but it was accelerating faster. This is pre-pandemic. My friends, this is pre-pandemic. So not only was higher by double, it's going faster. So I'm just saying, if you take a price to earnings number, price is the price. I'm not arguing the price. Price is the price, right? If it was $2,000 a share, it was $2,000 a share. Whatever the price is, divide by an earnings number. And if the earnings number is really 3 times higher, that means the PE is really 3 times lower. Not to mention a PEG ratio. If the actual earnings number, the uniform number, is growing faster, then the PEG ratio is going to be lower, the price to earnings growth. Of course it is. Of course it is. So of course, Buffett and his team, who don't look at GAAP earnings, they say it all the time, we're looking at a much higher quality earnings company with a much lower hurdle in terms of valuation, which you wouldn't get if you just look at the GAAP numbers and read the papers, right? Read the internet, the papers, what did I say, the papers, the internet, who reads the papers? Anyway, of course, right? Buffett was right. Even with the market fall off, Buffett was buying back there, right? Buffett was buying way back there at what? Split adjusted, 1,400 a share, whatever. So of course this is false, right? He was still doing good, solid investing. He's just looking at a totally different calculation than the rest of the world. So, by the way, this uniform accounting that I talk about, who's using this right now? I can tell you that of the top 10 investment management firms in the world, the AUM years, from a couple of years ago, but the top 10, the answer is all of them. Every single one is using uniform accounting. Now, I'm not saying every person there, but every single firm has a team that's doing some level of uniform accounting. They don't call it that at BlackRock. BlackRock doesn't call it uniform accounting, but they're doing earnings quality adjustments to get a level playing field across the world. Of course they are. Of course they are, right? And so is every single one. I could name the people, by the way. I mean, I won't, but I can name the people at each of these firms, right? Many cases I know them personally. In other cases, they're just clients who subscribe. And of the biggest 300 in the world, there's more than 230. So if uniform accounting is new to you, you better consider it at least, right? Versus using GAAP numbers straight out of the box. This number is old. We probably have 40,000 plus subscribers, individual subscribing entities. That could be one person or it could be 100 people at one firm. Anyway, there's a lot of people using uniform accounting, not just through us, but doing it on their own. And part of the reason is because we're doing this 32,000 companies. So every week, we can't update daily, but every week we update 32,000 companies. We have a giant database. We've got about 150 people, and we create this uniform numbers, right? And we have to do it globally. As Jean-Marie Eviard said, speaking at CFA Society in New York, he was there, and they said, Jean-Marie, you're one of the greatest investors of non-US stocks. You're known for your expertise with foreign companies. Do you restate the financials under international accounting, or is international accounting much better than US GAAP? And what does Jean-Marie say at the CFA Society in New York? I mean, I love these CFA events because you get these awesome debates and interesting insights. Always restate financials when valuing companies, said Jean-Marie Eviard. Always restate financials when valuing companies. Not sometimes, not once in a while, not, first look at it and do your screens and then adjust. You're going to be looking at the wrong companies. Do your screens and then dive into the company and you make your adjustments. No, from the top, you've got to do the adjustments. Otherwise, your entire sample size is wrong when you look at cheap PE, high earnings growth. That is a terrible method using GAAP, given that the PE and the earnings growth are wrong. I mean, they're correct according to US GAAP, but the adjustments are inconsistent from company to company. So we apply this and we do this in aggregate. We get 200 years of market cycle research, right, to include, speaking around the world. So this is May 2019. I was speaking at CFA Society of Beijing. It was in person. And unbeknownst to me at the time, there was a problem breaking out. What was it? So people always ask what I learned when I'm inside the Pentagon, because I certainly learned some things that I'm allowed to share that I'm just like, this is not common knowledge. And it is inside. So anyway, one of the insights from inside the Pentagon that probably has nothing to do with valuation other than macro was, what month did the Chinese military, PRC, did the People's Army of China, PLA, anyway, the People's Army of China, what month did they start buying exponentially higher SARS-CoV equipment? This is a fact. This is a fact. What month did the People's Army start buying COVID equipment for their military at levels that were beyond anything you've seen all the way back to SARS 2005, 2004, 2005, 2006 timeframe? More than, I mean, just unbelievable. You could see the purchase orders, right? How do you see the purchase orders? That's more complicated. But you can see all the purchase orders that China's government, China's army was making, and it was off the charts. When do you think it was? January of 2020? No. September of 2019? No. No. The giant ramp up and spike of China buying massive amounts, exponentially higher amounts of SARS equipment was May of 2019, unbeknownst to me while I was speaking at CFA Society of Beijing. Unbeknownst to me. I had no idea. I had no idea at the time. Of course, who did? But I found out some time ago recently when I was inside. They said, yeah, we pretty have a good account. What other reason could China be buying that kind of COVID equipment? Sorry, at the time, they didn't call it COVID. SARS equipment, unless they knew something was amiss. Just saying, something was amiss. Anyway, that's probably the last time I'll be able to speak at CFA Society of Beijing, because I don't think I'm allowed inside the borders of China anymore. I'm just not going to take, I'll roll the dice. I'm not going to roll the dice on that one. Anyway, when I was there, I showed 700. It was 700. 700 is, right, Tencent, big company in Hong Kong. Now, when I say China, of course I include Hong Kong, because let's face it, anybody, Hong Kong is now China. It's been fully assimilated. How do we know? I don't know. Like 2 weeks ago, they arrested 9 nursery school teachers, 9 elementary, young children teachers. For what? Because they were reading a book that displayed mainland China as a wolf and Hong Kong as a sheep in this children's book. Well, that's it. Not going to see those teachers anymore. So let's, realize Hong Kong is China. Whenever we do our macro analysis, we include Hong Kong with China. We include all Hong Kong's companies. Of course we do. They are under the thumb of Hong Kong now, of China. Of course they are. So anyway, here's Tencent. Here's the stock price going up 150 times versus the market. And here are the Hong Kong accounting numbers. It looks like their best year was 2009, and their earning power has been falling ever since. In reality, here's reality. Ready? This is what I showed in Beijing. Better than Amazon. Better than Amazon. 10 cents returns are unbelievable. Better than Netflix. Fantastic. As Dr. Barry Epstein says, this is the #1 accountant on the planet. By the way, that is a statement of fact. The #1 CPA on the planet, meaning his testimony in court has never been refuted in 35 years. 35 years, he'll testify, this is what the accounting is, and it's always the other accountant who's wrong. And I'm talking about all kinds of accounting malpractice, litigation, you name it. So literally the #1 CPA on the planet. Very good friend of mine. It's who I learned from. It's because of what I learned from him that I have such bravado when I talk accounting. Anyway, GAAP accounting. He wrote the GAAP guide for like 20-something years. He wrote the International Accounting Standards Guide for like 10 years. And when it changed to IFRS, he wrote that guide too. These are all 1,000-page books. These are de facto guides to accounting. And Barry said in his book in IFRS, by the way, IFRS adds to the risk. It's riskier. Risk what risk? Risk that the accounting doesn't represent what you think it's supposed to. So don't say that IFRS is better than US GAAP, because it isn't. I've heard that many times at CFA programs. I heard it when I was in CFA Paris. I heard it in CFA London. Our assumption is US GAAP is behind the ball and IFRS really has moved forward. No, the reason why US GAAP has not converted to IFRS is because IFRS is worse. IFRS is worse. Yes, it is. That is why US GAAP has never converted to IFRS, because people realize that IFRS is not a standard. It's a bunch of guiding rules. It's not a standard. It's not a standard. There's even more judgment going on company by company, year to year, for what accounting should be done. This is a big alcohol company in China. By the way, you drink this alcohol and whoa, this messes you up. Anyway, look at the returns. Highest stock price returns ever come 2018, 2017, when I was in 2018 estimated. I was speaking in May 2019. The problem with China's numbers is in May 2019, you still don't have all your 2018 financials in. So even in 2019, you're still looking at your last full year's 2017. But regardless, when you look at the numbers, here's what you see. And it's that there's a massive upswing in returns that was not being picked up in our GAAP numbers, which is why the stock price was on such a crazy upswing. So what do we get to? On a macro basis, right, what everyone's waiting for, we do have bull and bear cycles, right? And earning power under uniform accounting goes up and down with those bull and bear cycles. It's always lagging though. Multiples peak under uniform accounting. Multiples peak in the market top and they're lowest during capitulation. That's not the case with GAAP earnings because of a thing called the Big Bath. During periods of capitulation, 2009, 2001, right, 1980s, right, any bad year, companies take all these write-offs. And in that year, the earnings number is no longer comparable to the year before. So the S&P 500, Wall Street Journal was reporting in April of 2009. They're reporting April 2009 that the PEG ratio, and they just said even just a plain old PE had hit like 60 times. Well, of course, because companies are doing all these crazy write-offs, non-cash, multi-year write-offs taken in one quarter or another quarter. So their earnings number was much lower and incomparable to prior quarters. And so the journal was saying, this is even at the bottom of 2008, the stock market could fall 60% because PEs are still 50. And you're like, yeah, but you're using a measuring stick that just changed. How can you use the same measuring stick in 2009 as 2008 when companies are literally applying different accounting rules in 2009 than 2008? So anyway, if we're going to look at multiples, we got to be smart and use uniform-based multiples. We don't, allow for the impact of Big Bath write-offs. We got to have the same calculation of earnings in 08 and 09 and 2010. Otherwise, we don't know whether we're in a recession or not, right? We have to have the same calculation. And of course, there's sentiment and there's credit. Credit is the canary in the coal mine. Look at that. Credit tightening occurs during the growth stage of a bull. During is a very important point. It's never been credit starts tightening, the stock market collapses. There's always a blip when credit starts tightening, right? And then the market goes on to being strong if earnings and earning power is still there. And then we have to look at government intervention, other leading and lagging, mostly lagging economic indicators. But either way, this is what we're going to apply. First, we're going to look at credit in China. All right. So here's corporate China. This is the data I was showing. This was actual slides from I was showing in the Pentagon early 2021. Right. So 2021 was an estimate, of course. What this is showing is Evergrande and their debt level. The first stacked bar is their debt level. Just the first bar. That's their debt service. Sorry, not debt level. That's their debt service. That's the amount they need to service their debt that year, principal and interest. The blue line is the cash from operations. By the way, not the GAAP cash from operations. And if anyone knows this, the statement of cash flows is a joke. It is. Sorry, I know people follow themselves, people that don't study the accounting enough. The statement of cash flows is a joke. It's not calculated consistently from year to year. Cash from operations is not actually cash from operations. Cash for investing does not reflect cash from investing. For all kinds of accounting nonsense, it's terrible. Otherwise, everybody would be using cash from operations for their earnings number. Why don't they? Because it's not. Anyway, so the blue line is the true cash from ops number available for debt, right? The blue dot is cash on the books. So if you take their cash and all the cash on the books, they cannot service their debt in 2021. They couldn't. And it doesn't look much better when you look into the forward years. Meaning, at no point do they have enough cash to cover their full debt service and other things like, maintenance CapEx, right? Pensions, dividends, rent, whatever they're spending on. And by the way, warnings from credit didn't start appearing until September 2020. Here's what was showing in our database in 2019. This is 2019. Ugly. Blue is the cash. The red is the debt service. This company did not have the cash cover debt. So what they're doing was they're just massive refinancing every year into the next year, and then doing it again and doing it again, kicking the can down the road, right? What I'm telling you is the credit crisis that China's experiencing did not start because of the pandemic. It started long before the pandemic. How do we know? Because we run credit analysis on every single public listed company in China, including Hong Kong, including Shenzhen and Shanghai exchanges. And let me show you this company called Wonders Information. It's an IT consulting firm. Of all the industries in China, you'd think that would be a solid balance sheet, be an IT consulting firm. And take a look. That is their debt service required this year, 2022. The blue line is cash from their operations. The blue dot is cash on hand. This is an IT consulting firm. What on earth is an IT consulting firm doing with that level of debt? What are they using it for? IT consulting is a very asset-light business. It's crazy that a company has that level of debt. Right now, if they make it through this year, right, if they do, then maybe they'll have enough cash flow to restructure and shrink, but they still don't have enough for maintenance CapEx. They don't have enough for even covering all their rent needs or whatever. And this is just an IT consulting firm. We calculate an ICDS. For those of you that know anything about credit, it's a credit default swap, but it's an intrinsic one because there is no traded credit default swap, even though this is $1 billion company in China, right? Well over $1 billion market cap in US dollars, over $1 billion, right? It's basically a uniform Z-score, sort of like the Altman Z-score, but uniform. Anything above 500, it's like a uniform Z-score, but we scored it in numbers that are relevant to a credit default swap. So you can, if you know CDSs, you could say 9, 10. That's unbelievably expensive. That means highly bankrupt, highly chance for a bankrupt. Like, yes, unless it gets bailed out, right? Which it probably will, because it's big enough, right? But it's going to require a bailout, right? That's what the CDS says. Here's Shenzhen Hemai Group. Now, Shenzhen, this is an electronic equipment company in the Silicon Valley of China, right? Shenzhen is the Silicon Valley of China. First off, their cash flows are negative. So there's no way going to service their debt or their interest expense unless they have a massive bailout. And it doesn't get much better the next 5 years, right? This company is not earning money. They're just not, right? This, by the way, this is $1 billion plus company. These are not tiny little $10 million firms I'm showing. These are $1 billion US dollar, $1 billion companies. And their ICDS is 1,000 plus. In September 21, the number of companies in our database that had an ICDS over 500 was 350 companies. That is worse than United States 2008 by X-fold. Multiples worse. No way in the United States did you have that many companies with that kind of a CDS, right? No way, even on our intrinsic CDS, you just didn't. No way. And yet, how has it gotten July 2022, right? Today, 3 months ago, more than 1,400 companies in China are at risk of default. Now, do I think they'll default? Do I think they'll go bankrupt? They can't because there's no bankruptcy rules in China. What they're going to have is massive, massive bailouts, companies all not paying each other's bills, massive restructuring, government intervention that's going to be necessary on a scale nobody even thought of in 2008 for the US or Europe. I mean, it's unbelievable. And it's not just real estate, as I've showed you. It's everywhere, including the IT industry, which should be booming. Including consulting, which is an asset-light business. And we see credit issues. The amount of credit on the balance sheets is so much that they can't cover their debt service. Yes, if you just click through, you would see 1,400 companies with a picture that looks like this, where you're like, here's the cash flow, here's their debt service. Someone's going to have to bail them out. We're looking at the most massive bailout we've ever seen anything. And this is worse than the Great Depression in the United States. Worse. Now, do I think they'll have a Great Depression? No, because I think what they're going to do is just freeze everything. Kind of like what they do with this COVID lockdowns. That people are wondering, what are all these COVID lockdowns for? You got to freeze everything. This is the way to do it. Blame it on COVID. Don't think the credit crisis in China is because of COVID, because it isn't. It's gotten worse because of COVID. This started years ago. Tax revenue in China peaked and really flattened in 2018, 2019. That was not the COVID crisis. In 2020, of course, it's less. China tax revenue, that's 15 trillion RMB. That's about 2 trillion US dollars, right? It peaked already, right? It already peaked prior to the pandemic. By the way, China FDI, everyone's like, oh, China Belt and Road. I get asked this in the Pentagon, right? Is China gonna, have this crazy Belt and Road expansion where they start taking over pieces of the world? They don't have the money to do it. Peaked in 2016. Chinese company global M&A of non-Chinese companies peaked in 2016. Chinese FDI, foreign direct investments of China into other countries, peaked by the Ministry of Commerce and the State Administration of Foreign Exchange in 2016. And it's been downhill since. And it's going to stay that way. So this idea that China is going to take over the world when they don't have the money to even restructure what they're doing, it's just crazy talk. Crazy talk, Fortune magazine. It's crazy talk to say it. What about the US's credit? Well, I'm going to show Amazon again because Amazon got 50 billion of debt. I don't know if you knew that. 50 billion of debt. But take a look at their chart. Total debt service, all expenses, maintenance capex, R&D for the year, even if we forecast it to grow, and their operating cash flow soars above it, and then cash on hand, even if Amazon collected no money in 1 year, they have more than enough cash on hand to cover all their debt service 3-4 times over. And that's why they have an ICDS of 20, meaning this company is investment grade all day long. And guess what? Amazon is a microcosm for what the US looks like. Here's the US corporate America. We take every company in the US, this is as of July, right? Every company in the US, and we create the same chart for every single one. And guess what? US companies make more than enough money to cover everything. Debt service, interest expense, increases in R&D, maintenance capex, you name it, pension servicing costs, even pension servicing costs. US companies make more than enough money to fund it. And on top of that, they're sitting on a cash on the balance sheet, that blue dot, that even if you had a pandemic year, listen to what I'm saying, even if you had a pandemic year and companies made no money, you wouldn't have a debt issue. I'm talking about corporate America, publicly listed companies, not small businesses, because small businesses, unfortunately, did not have such cash on hand. That's why we saw massive bankruptcies in small businesses in 2020. But somehow, the S&P 500, yeah, we saw one, Hertz. By the way, don't let Hertz blame the pandemic for their problems, right? Hertz's problems started like 12 years ago. Anyway, Hertz, the car rental company. So anyway, this is corporate America. What about US national debt? Let's do the same analysis. So let me show you, right? High middle income American. And this, I'm just going to say he's a plumber, right? I'm not going to say he's Joe the plumber because everyone's talking about this fictional Joe the plumber. And then someone actually said, no, I'm Joe the plumber, and became an actual person. So, Steve the electrician. And Steve's been doing really well. He's a master electrician, right? And his take-home pay is 40 grand a month after tax. That's 480 grand a year. Pretty good. Yes? And his monthly mortgage payment is a meager $3,500. That's it. It's a small amount. His debt service is $3,500 a month, or annually about 42 grand. Is there any banker listening right now, any credit analyst that would say this guy is not going to get the best interest rate out there? Of course he is. Anybody worried that he's not going to be able to pay his bills? Now you could argue, what if he loses his job as an electrician? What if he loses all his projects? Every project as a master electrician he loses all at the same time. Highly unlikely, but let's say that happened. Let's say it happened. All right, well, it's good news. He's got a bunch of assets, about $40 million. He's a saver, 40 million. Now let's say it's only 20 million. Let's say it's only 10 million. Who cares? It doesn't matter if it's 10 million or 40 million. Either way, this guy is AAA all day long, no question, right? Steve the electrician. And he does spend on his home alarm and security system because it's a nice house. He's got a lot of assets. He spends 76 grand a year in his home alarm system. And he does actually has a guard, right? Full-time guards. Right? So he spends 76 grand a year. Reasonable. Anybody not going to loan him money? Anyone? All right. You know what I just showed you? Steve the electrician is the United States of America. The United States of America collects this year 4.8 trillion. You just got to multiply by 10 million. $4.8 trillion of taxes. The US debt service is about 35 billion a year. Yes, it's going up because interest rates are going up. Let it double. I'm just saying, even if it doubled, even if it tripled, even if Steve had to pay $10,000 a month, are you really worried he's not going to be able to make his payments? He might not be able to go to the movies as much. He might have to give less money to his family and friends. He might have to have a lot less in handouts supporting other people. but he's still going to make his debt payments. Of course he is. He's still AAA. And by the way, this is a few months ago, but do you realize how low the interest rates are around the world? Japan, Switzerland, Germany, Netherlands, and France. The US was paying a very generous 2.8%. I realize it's gone up. But just what hasn't changed is the relativeness of it. Meaning, if you want to get a better interest rate than loaning a AAA country, United States, it is AAA. Even if S&P or Fitch or Moody's say it's AA, they're insane. Of course, it's AAA. Ridiculous, right? You've got to loan money to India if you want to get a better rate of return, or New Zealand, or Greece. Are you crazy with the currency risk you're going to accept by doing that? Of course, the US is going to be able to go to the window anytime they want and say, hey, we want to refi our treasuries. And of course, they're going to be able to, naturally. So the annual payments of 420 billion, 420 billion, no brainer. No brainer. This is what good credit analysis is based on, not GDP. GDP doesn't represent cash receipts. Tax receipts is cash receipts to a government. You want to look at cash from operations? That's your cash operations number for the US government, 4.8 trillion. That's the amount that's available for servicing debt, which is a meager 10th of that number. Now, if it doubles, of course, we're probably gonna have to spend less in other areas. But meanwhile, the US is sitting on something like $400 trillion of assets. Don't sue me over this number, right? I've heard some people say it's a quadrillion. I've seen very good research supporting quadrillion. I've also seen good research saying, now it's barely 100 trillion. Doesn't matter. These are small numbers relative to a debt service number of 400 billion a year. Tiny. If you don't believe Steve the electrician is in problem, then don't worry. And by the way, what's the national defense budget? Again, why the Pentagon loves this example. It's nothing, relatively speaking, small amount. Think about that. The US national defense of 760 billion, easily covered by 4.8 trillion tax revenue, as long as Congress wants to, right? But the issue is, does Congress want to? Well, that's a Congress decision issue. The money's there. The money's there. And by the way, this interest rate issue, rising rates have never been a problem for the US stock market. I'm sorry. They haven't been. Look at every chart out there. High rates are the problem. And we are nowhere near high rates in the United States. Nowhere near. We're heading there, but we're not there. And until we're there, we're not at a problem level. What is a high rate level? Go back in time and look at when the US stock market has truly gone to a crazy bear market. And I know people are like, technically we're in a bear market now. Hold on a second. The reason why 20% in a bear market usually makes sense is because usually the stock market goes up 6.5% real a year. So if the stock market goes up in the last 200 years, 6.5% a year, 6.5, 6.5, 6.5, and then falls 20, you just gave up 3 years of returns, right? That is a bear market. But when the stock market goes up 76%, which it did post-pandemic, and then falls 20%, it's not really the same kind of thing, is it? Right? Especially when we have full employment, which we do, right? And we have rising interest rates, but we do not have high interest rates. We don't. Sorry, we don't. We don't. Now, are US companies falling behind in all this mess? Let's see. Is this picture a good picture? It is not, right? In 2018, pre-pandemic, China's market cap was $6 trillion, right? It doubled. Post-pandemic, it doubled to 12 trillion, right? You're like, holy moly, amazing. But the US was already 29 trillion. And in those same years, the US went to $50 trillion market cap, right? Which means the increase alone was more than all of China combined. Just the increase was more than all of China combined. So this idea that China's catching up to the US is kind of a silly conversation when the increase is more than all of China. And by the way, if we add all the other countries, add every other country together, guess what you get? Less. This idea that China's number 2 is like saying, yeah, it's Michael Jordan and China's the number 1 high school basketball player versus Michael Jordan. That's what you're talking about. It's ridiculous to say that they're number 2 in any way that matters truly. Yes, GDP, but just because a country has more transactions, that's what GDP is. GDP doesn't even mean revenue. It just means more transactions. That doesn't mean the transactions lead to cash receipts that lead to a country's spending ability, because they don't. They don't. And by the way, I just ran this in early 2022, and guess what? The US was 60% of all the market caps of the world combined. The US is bigger than the whole planet. And they're like, but maybe it's because the US is in a bubble, right? By the way, this idea, here's the picture you should be looking at, this picture. Instead of looking at, oh, US share of GDP is shrinking and the rest of the world is growing, we should be saying, no, the market capitalization, which is what matters, has been skyrocketing, and the rest of the world, thankfully, is growing, but not at the pace that the US is. It's not even close. It's like the US is bigger than the whole world combined, right? Now, are US corporate earnings at risk? Let's see. 2008, earnings fell to 300 billion. 2009, 285. And man, that number has skyrocketed. At its worst in 2020, the US was still at the third highest level in history for economic profit. That is return on assets minus cost of capital. And man, did that jump in 2021 and continues to, best guess 2022. It's going to be higher. It's going to be less higher than we would have thought, but it's going to be higher. And here's China, including Hong Kong and Shenzhen and Shanghai, not even what, and this, by the way, 2022 is a generous estimate because we don't have any financials really. I mean, we do have some financials, but we don't have a full boat, right, of what represented. So this is a pipe dream number versus 2022 in the US, right? So we're looking at something like an eighth to a tenth of the US's economic profit. That means China doesn't have the money for R&D. They don't have the money to pay the taxes. They don't have the money that the US companies can pay, right? What about the crisis of 2022? Well, look at MSCI World Index, which of course is based on, here's the developed markets of the world, right? Based on economic development, size of liquidity, market. This is MSCI. I think MSCI does a good job of this. Here are the developed markets. Here are the emerging markets. Here's the frontier markets based on the same things. And here's the standalone. We don't know what to do with them. Well, let's take a look at these markets. Because it's scary. There's this new axis of evil being created, apparently. The press says China and Russia and Iran and throw in Saudi Arabia and I don't know, throw Venezuela in there too if you want, Cuba, right? I'm just asking, how many of those are in the developed market world? Only Hong Kong. That's it. So look at all the developed market countries that are all working together. I mean this, working together, trading openly, banking systems that are open, right? How many do you lose in the emerging markets? China and that's it. Okay, Russia and Ukraine, we'll put a question mark behind Ukraine. Saudi Arabia will put a question mark. I don't know, Bahrain will put a question mark. But look at all the other countries that are freely, openly trading with the United States and the United States economic system. So this idea that, I've heard that China is going to be the center of the new economic world is a pipe dream. It's ridiculous. It's ridiculous. It's like they're picking off like, all right, a couple of minor little Iran or something. Big deal relative to the rest of the world. What we're looking at, right? Because people said it's the end of globalization. No, we're looking at a new globalization, non-Russia and less China. China's still going to be part of it because they need to be. They need to be. U.S. corporate revenues depended about 5% on Chinese purchases. China's corporations, I think 2/3 of China's salaried personnel are dependent on sales to the United States. So when we get in these tariff wars that occur, China does not have the upper hand. Things would get more expensive in the United States, yes, but you're not going to have 2/3 of the United States out of work if the US and China went head to head on tariffs and these things, right? Because the US will continue to trade with the rest of the planet, minus, all right, the red boxes and slashes. So as world military expenditure crosses $2 trillion, who benefits? Of course, the United States, the #1 aerospace and defense exporter, more than the rest of the world combined. This is not #1, #2. This is the US and everybody else combined is #2. How about the food? Well, let's see. Knock out Russia, US is the #1 wheat supplier of the world. #1, right? And by the way, if the Biden administration, and not just Biden, but last year was still paying farmers to burn their crops or to not plant, stop that, and the US could easily be #1 wheat exporter on the planet. Easily. Could support the world. It's going to take time. It's going to take another season. It could be done. How about the oil crisis? Right? Well, who's the #1 producer of oil in the world? The United States. Who's the #1 natural gas producer? The United States. Right? Our director of research, Rob Spivey, has been writing this for a while, calling it, there was a shale revolution, but the shale renaissance is coming. And the shale renaissance is getting it right in CapEx. It's getting it right in profitability and efficiency. You're going to see it. You're going to see it happen. Right? It's amazing. And by the way, here's a whole bunch of other industries, another $500 billion that the US supplies the world, that the world needs as it rebuilds under this new globalization, right? Non-Russia plus. Even consulting revenue is mostly originates from US companies. It's crazy. So no, this dollar amount, this US economic profit isn't stopping anytime soon. US companies that generate more economic profit than the whole rest of the world combined. Because someone said, maybe the US is in a bubble and that's why the stock market's bigger than the whole world combined. I'm like, no, because we can calculate economic profit, and economic profit in the US is bigger than the whole planet combined. Look at China's number 2 there. Look at 2021. And this is continuing in 2022, right? It's not going to grow as much as people hope, but it's continuing. So what we're looking at is this Pax America 2100. Let me find my last slides. US tax revenue versus China tax revenue. This is drawn to scale. So while China's tax revenue peaked in 2018 and has been shrinking, 2018, 2019, the US has done this. Yes, the increase in US tax dollars in 2022 alone is almost as much as the entire budget of the US national defense. You know what that does? That has Pentagon officials going, whew, sigh of relief. The increase alone from 21 to 22 is more than enough to cover the entire, almost the entire US military budget. Not the case in China. In China, that military budget is crushing their economy. It's crowding out money available they're gonna need for this credit crisis that's going on, right? We're looking at a situation where, by the way, where the United States will be collecting more tax revenue than the whole world combined. That's the situation we're looking at. So anyway, let me just say this. We publish this F Alpha Pulse, Charlie. This is my only sales pitch. People just ask me. If you go to falphapulse.com, you'll hear this monthly about our geopolitical crisis. You hear what we were talking about. You also get access to a number of our data and everything. And by the way, it's so inexpensive, it's almost free. This is not a big institutional sale I'm talking about. So if you want, go to Alpha Pulse. And if you want like a discount on that by 70%, if you think it's not cheap enough, just email FA. FA's on the call right now. Literally just email him and he'll give you a discount code to make it, and it's like not even like $99 for a year or something like that. So, it's enough you can stay in touch with us and get our great macro. So anyway, Charlie, that's it. That's my only little plug. But any Q&A, I'm happy to hang on. Thanks for the time.
We have a few questions. I know we're running up against the hour, but this question came kind of midway through your talk. Yeah, and it's from Kyle. It says, "Are you saying that the market follows uniform accounting, adjusted accounting, as opposed to GAAP for domestic stocks, or are adjusted accounting statements that well adopted?"
Yeah, so I'll tell you, BlackRock is doing it, right? So you ask, is the market? I would say the top investors, whether it's Buffett or any of these people, yeah, absolutely. I don't think there's any question that if 230 of the biggest 300 investors in the world are using my version of uniform accounting, and there's other versions out there that also I'll say are good. Of course, I'm going to say ours is the best, but there's other firms doing it. There's a lot of firms doing it in-house. So I do believe that the market over time moves on uniform accounting, but the volatility you see day to day, yeah, reported earnings will create volatility all day long. And then people figure out, okay, Amazon lost money, that creates some volatility. Then like, oh no, Amazon really made money if you make these adjustments. So the financials are good enough to make those adjustments. Yeah.
Okay, great. And then one last question. You mentioned your skepticism that the cash flow statement reflects true cash flow. Can you give a couple of examples of such differences and what adjustments you tend to make to the cash flow statement in your analysis? Thank you.
Sure. So one, we're going to make the presentation available. FA, we have an article called "When Cash is Cash and Why." By the way, if you subscribe to FA Alpha Pulse, you get actually access to that the Financial Advisor Academy. And in the Academy, we have all kinds of content like this. So let me give an example. FedEx and UPS, totally incomparable cash from operations. What? Yes, totally incomparable. Why? Because FedEx, when they rent assets in such a way, they specifically tell the lessors, the plane lessors, do not trigger the lease capitalization under accounting. Don't trigger it. We want the rent to show up as a negative cash from operation and make our balance sheet look really light. This is a FedEx thing. It's a statement of fact. Whereas UPS, does not do that. UPS is buying and capitalizing. So when you look at UPS's CapEx, it shows up in our cash flow investing. When you look at FedEx going out and renting 400 planes and whatever else they rent and warehouses and hangars and you name it, it never shows up, almost never shows up as a capital expenditure, as a part of CapEx, because they choose. This is a choice. They tell the lessor, don't trigger the lease capitalization rules. And every lessor in the world knows the lease capitalization rules better than everybody on this call, better than most CPAs. Because they go to a company and say, hey, do you want this lease to be treated as a capital lease or not? And right there, that cash expenditure will either show up on our cash for investing or cash from operations. It's a decision. It's a decision. It's not based on what happens. That's one of like 10. I mean, I'll tell you, the fact that interest expense still shows up as the cash from operating number and not a financing number for non-banks is just insane. I mean, for a bank, of course, it makes sense. So they asked for a couple examples, Charlie. That's my 2. Interest expense and R&D, but I could go on. There's another 10. It just makes cash from operations such a bad number to look at, which is why people don't use it. It's philosophically, it makes sense, but the practice of how US GAAP FASB put it in place, by the way, it was FASB, I think it was 97, no, FASB 85. It was put together, FASB 85 in the late 80s. It was horrible. And everybody argued and said, this doesn't make sense. And then everyone forgot. And it's still the same accounting rule. So, Charlie, thank you for the time. Sorry I went over. I get so excited. I get these stories. I apologize for going over.
That's okay. I can tell your enthusiasm. I appreciate it. CFA Society Atlanta really appreciates it. Thanks to everyone for joining today and connecting with us. Please think about attending future events. We'd love to have you. Look for an event survey for this webinar to follow in your email. Thank you so much, Professor Litman. Really appreciate your time, and I hope everyone has a great rest of your day.
Thank you. Thanks, everyone.